All right, so today we are tackling one of the most popular investing strategies on the planet, dollar cost averaging. You've probably heard it called the simple, stress-free way to build wealth. But here's the kicker. What if its biggest selling point is actually based on a subtle but really powerful logical mistake? Let's get into it.
Okay, so let's start with the problem we all have to deal with. I love this quote from investor Joey Yang because it's so true. Trying to time the market is a nightmare. A stock dips, do you buy now? Do you wait? What if you wait too long and miss the boat entirely? And that feeling, that stress, that's exactly what dollar cost averaging, or DCA for short, is supposed to fix. So, what's the big promise here? I mean, for decades, this has been the go-to advice for regular investors. It's sold as the ultimate cure for anxiety about when to invest. It's disciplined, it's automatic, it's simple.
Okay, so what is it really? It's actually super straightforward. Instead of trying to find that one single perfect moment to invest a bunch of money, you just commit to putting in a fixed amount, let's say $100, at regular times, like every month. And you do it no matter what. Market's up, you invest. Market's crashing, you still invest.
Okay, so let's see how this actually plays out. Imagine you're investing $100 a month. In January, the price is $50 a share, so your $100 gets you 2 shares. Simple enough. But then, in February, the market dips, and the price gets cut in half to $25. Now that same $100 buys you 4 shares. And that right there, that's the magic of it. When prices are low, your money automatically buys more, and when they're high, it buys less. It just naturally smooths out your average cost.
And that, my friends, is the promise of DCA in a nutshell. It's all about taking your own worst enemies, fear and greed, out of the equation. You're not going to panic sell when the market tumbles because the plan is to just keep buying. And you get less of that FOMO, that fear of missing out when things are soaring because you're already in the game. It just turns investing into a calm, steady habit.
Okay, sounds pretty great, right? Almost foolproof. But what if the whole thing, the very reason we find it so appealing, is actually built on a hidden mistake? Some really interesting research from the Cass Business School suggests that maybe we've been looking at this all wrong.
I mean, that's a huge claim from researcher Simon Haley. He's not just saying DCA is suboptimal, he's saying its popularity is thanks to a demonstrable cognitive error. What he's basically saying is, the reason DCA feels so right isn't because of how well it works, but because of a flaw in the way we think about it. So what is this so-called error?
Okay, so think back to that popular argument we just talked about. The idea is that because you buy more shares when prices are low, your average cost for each share ends up being lower than the average market price was over that whole time. And on the surface, that sounds like a no-brainer, a guaranteed win. I mean, buying stuff for cheaper is always better, isn't it?
But here's the question that blows the whole thing open. When we say DCA's average cost is lower, well, lower compared to what? The answer to that question is where the cognitive error is hiding. Okay, so to get to the bottom of this, Haley's research pits DCA against a couple of other strategies. One is a realistic alternative, just buying a fixed number of shares each month. But it's the second one, this ESA2, that reveals the flaw. To make this strategy work, to spend the exact same amount of money as the DCA investor, you would need to know all the future prices in advance, which, requires a crystal ball. It's literally impossible. And this is the real bombshell. That whole lower average cost thing only looks good because it's being compared to this fantasy strategy that uses perfect future knowledge to make bad decisions on purpose, like buying fewer shares right before a price jump. It's a rigged comparison, and it's what makes DCA seem better than it really is.
Okay, so that brings us to the main event. If the central mathematical argument for DCA has a crack in it, what's left? Well, it really comes down to a classic battle. Cold hard math versus messy, emotional human psychology. So, in one corner, you've got lump sum investing. This is the argument from math. If you've got the cash, the numbers say you should get it all in the market at once to maximize your time in the market. And in the other corner, you've got DCA. This is the argument from psychology. It's all about avoiding dumb, emotional mistakes and that awful feeling of regret, even if it costs you some potential profit.
All right, so who wins the fight? Let's look at the data. Well, Morgan Stanley crunched the numbers, and they came up with this, 56%. That's how often, historically, lump sum investing has delivered better returns than dollar cost averaging. So yeah, on paper, the math has a clear edge. And the reason why is actually pretty simple. Look, over the long haul, markets tend to go up. That's just how it works. So by holding your cash on the sidelines and dripping it in slowly with DCA, more often than not, you're just missing out on gains. It all comes back to that classic saying,
Time in the market beats timing the market.
But hold on, because the math isn't everything. The psychological case for DCA is super strong. Let's be real, dumping a huge pile of cash into the market all at once is terrifying for most people. What if you do it the day before a massive crash? That feeling, that regret risk, is so powerful it can stop people from ever investing at all. DCA gives you a system to get past that fear and just stay in the game.
You know, this quote from Vanguard just nails it. It's perfect. Think of DCA like you're buying insurance. Most of the time, you're paying a small price, in this case, slightly lower expected returns, for protection. But you're not protecting against a fire or a car crash. You're protecting yourself against the absolutely gut-wrenching emotional pain of regret. And for a lot of people, that insurance is well worth the cost.
All right, so we've heard the case from the mathematicians and we've heard the defense from the psychologists. We've seen the numbers and we've talked about the feelings. So, where does that leave us? What's the final verdict on dollar-cost averaging?
And the real answer is, well, there isn't one single best strategy for everyone. It's just not that simple. The right choice for you depends on two things: your financial situation and, maybe more importantly, your personality, how you're wired.
Okay, let's make this super practical. If you suddenly get a bunch of money, like from an inheritance or selling a business, and your number one goal is to squeeze out every possible penny of long-term return, then the math says go for it. Invest it all at once. But if you're like most of us, investing out of your paycheck, or if you just know that a big market drop would make you want to sell everything and hide under your bed, then DCA isn't just a good strategy, it's probably the right strategy for you.
At the end of the day, here's what really matters. It's not so much which plan you choose, but that you choose one you can actually follow through on. A good plan that you actually stick to is a million times better than some perfect plan that you ditch the second things get rocky. Consistency is everything.
So I want to leave you with a question to chew on. You have to ask yourself, what is the bigger risk for me? Is it the mathematical risk of missing out on some potential gains? Or is it the emotional risk of making one big decision that you might regret for years? Your answer to that question will tell you everything you need to know.